Well, good morning, options traders, and I thought this would be a really good tutorial here for all of the new traders to talk about a big mistake that I see with a cost of exercise calculation. So what am I talking about here? What I'm talking about is any time that a trader wants to exercise a call option, there is a cost to do so. It's going to create a certain cost basis on those shares. Now, of course, in most cases, it's going to be rare that traders exercise a call, but there are certainly times that that's going to happen. And there are a lot of websites and even some of the more prominent books out there that will show you the cost of that exercise. And there's just a very big misperception and mistake in the way that they're going about it. So what is the cost of exercise? Well, let me show you the mistake first. This is how, again, a lot of prominent books and websites will tell you to think about it. Let's say that the stock is trading at 100 and you own the $90 call, trading at parity. We're close to expiration. It's trading just for the $10 of intrinsic value and no time value. Well, remember that whenever you exercise a call, that's the only thing you can do. You can't exercise it and also close it. You get one choice or the other. So according to these people, again, the ones that make the mistake, they'll say, well, because you don't get to sell this call, you have to account for that. It's an opportunity cost that you're giving up. So if you're going to exercise, you're giving up or kind of throwing away $10 of value. And then you're going to exercise and spend the $90 strike, and therefore your cost is $100, the same as the current market price of the stock. So again, it kind of sounds logical. You're giving up this $10, so we need to account for it as a cost. But why can't that be right? The reason is that exercise and closing are two different ways of doing exactly the same thing, assuming we have no time values. So watch what happens to our cost basis if instead we decide to close. I could say, you know what, they're right. I don't want to give up that $10 of value, so let me close my call and I'm going to put that in my pocket. I'm going to collect this $10, but now because I've given up that call, I can't spend 90, but I'll go out into the open market and spend the 100. Well, what's my cost basis now? Plus 10 minus 100, my cost is now 90. So think about that. How is that possible? How is your cost $100 if you exercised, but your cost is 90 if you closed it and still bought the shares? Why the difference? The reason is, and the reason for the mistake is that the $10 market price in this example isn't the price you paid. It's very simply the value of the call at that moment. So the cost of your exercise is very simply the strike price. So let's go back to the example here and see why. I'm not going to count that $10. I'm going to say if I choose to exercise this call, I'm going to spend the $90 strike. I will receive stock worth 100. And what's the difference here? That is an unrealized gain of $10. That's where this $10 is coming from. It's showing you that there's $10 of value currently in this call. It's not saying that's what you paid for it, which is why we don't want to consider it as a cost. Now, to further drive home the point, at this point I could sell those shares and pocket the $10. So did we really give up the 10? No, if you exercise the call, you're just kind of hiding it as an unrealized gain. You didn't really sacrifice it at all, and that's why it's a very big mistake to count it as a cost. So where does the cost come into play? Well, that's for current buyers. So let's say the stock is 100, the $90 call is currently trading for 10, and if you come along as a new buyer, you don't have that $90 call, and you say, you know what, hey, I could pull a fast one here on the market. I could go buy that $90 call and buy the stock at a discount. I could exercise it for 90 and get stock worth 100. Not true, because you haven't purchased the call. If you want to do that, you right now have to spend $10 for the call. Then yes, you could exercise and spend 90, and in that case, it is true that your cost would be 100, exactly the current price of the stock. Because that's the alternative, is to not buy the call and just go out and buy the shares. So yes, those two outcomes must be equal. But notice that is not true if you bought the call earlier. So if you want to get really technical, what is your cost basis in this example? Well, we would say with the stock at 100, what did you pay for the call? If you paid $2 for that call, then your cost basis is the $2 you paid for the call plus the $90 that you spent for the strike. Your cost basis is 92. And with a stock at 100, you would have an unrealized gain of 8. But the point to understand is that your cost is not the current market price. And that's because you didn't pay 10, and therefore it's a very big mistake to say that we have to account for it as a cost. And if you're making bad decisions with the calculations, you're making bad decisions with your money. For anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.